All right, so in the perspective section on your website where your blogs and quarterly letters are available, they are really helpful and great read, I must say. So coming to, so like, although nothing against any fund manager, but we have seen like just like retail investors, small retail investors, we have seen like even some people who are managing public money were like investing in FOMO. So and valuation is, sir, one aspect which is very crucial, right? So you guys also believe in secular compounding as a reasonable price, and I mean believe in giving a fair valuation to a company where growth is visible. So what's your view around this in the sense like is there I mean some pointers around your valuation framework?
You know, so the standard model everyone will use in valuation is actually a discounted cash flow, right? But see, the challenge with discounted cash flow is that it requires you to make a lot of assumptions, right? So you're making assumptions on cost of capital, right? There is no one cost of capital. I've seen people put using 10% as cost of equity in India. I've seen people using 14.5%. So there is no one number. Second thing is the model is very, very sensitive to both short-term growth rates and to terminal value, right? So we use DCF, but essentially we use DCF to kind of draw broad valuation bands, right? So, for example, we are very optimistic about manufacturing out of India right now. So, if we see a manufacturing business which is say about 18 to 20% return on capital employed, which could be say a 20% ROE business, which we think can grow at 15% for really long periods of time, and it's a business that we think has got a reasonable moat. In our internal framework, while we would want to pay not more than 20 times trailing earnings, if I really like the promoter, I might go up to 25 times. Now, so essentially what you're doing is that you're doing a DCF, but you're not trying to pin down a very precise number. You're coming up with a broad range. For a company we really like, we might go up to 35 times. And there is one company in our portfolio where we are willing to go even higher. But those are really, really very rare kind of assumptions. Very broadly, I think if we go, I start getting a bit uncomfortable paying more than 25 to 30 times earnings. And beyond 40 times is the real red line, right? Because the world is uncertain. There is so much of disruption that's happening now. There are other people who might be even more conservative than we are. There are people who might be more aggressive than we are. Everyone's got their own logic and their own thought process, but this is the broad framework that we use. Um, so, it's really a function of growth, ROE, what you believe is the longevity of growth, how much you like the management, what's the width of the moat, and then you make judgment calls within a broad range.
Right, sir. So